The big picture. Why Social Security changes in 2026 feel different. This time, when people hear that Social Security is increasing in 2026, the first reaction is usually relief. Any increase sounds like good news, especially for retirees living on a fixed income. But here's the reality many seniors are starting to notice. Even when benefits go up, the money you actually feel in your pocket doesn't always go very far. And that disconnect is exactly why the changes coming in 2026 feel different this time. On paper, Social Security benefits are rising. The cost of living adjustment, or COLA, is higher than last year and close to the historical average. That suggests stability. It suggests progress. But at the same time, many of the expenses older Americans care most about are rising just as fast, or even faster. Healthcare costs, Medicare premiums, housing, insurance, and everyday necessities are all putting pressure on household budgets. For retirees, this creates a frustrating situation. You may technically be receiving more money each month, but your financial breathing room doesn't improve. In some cases, it feels like it shrinks. That's why so many seniors say it feels like a raise on paper, but not in real life. And this is not about panic or collapse. Social Security is not disappearing in 2026. Payments are not stopping. But the system is adjusting in small, incremental ways that can have a big impact on how comfortable or stressful retirement feels. Understanding these changes calmly and clearly is one of the most important financial steps you can take right now. The 2026 COLA increase. What a 2.8% raise really means for retirees. One of the most talked about changes for Social Security in 2026 is the cost of living adjustment, better known as COLA. For 2026, benefits are increasing by 2.8%, and this adjustment applies across the board to retirees, disability beneficiaries, and SSI recipients. At first glance, that sounds reasonable. It's slightly higher than last year and very close to the long-term historical average. For the average retiree, this COLA translates into about $56 more per month. And let's be clear, $56 is not nothing. For many seniors, that amount can cover groceries for a week, help with prescription costs, or offset part of a utility bill. Every dollar matters when you're living on a fixed income. However, this is where expectations and reality begin to diverge. The COLA formula is based on an inflation index called CPIW, which measures spending patterns of working adults, not retirees. And retirees spend their money very differently. Healthcare, housing, insurance, and medication make up a much larger share of senior expenses, and those categories have been rising faster than general inflation. So while Social Security benefits are technically increasing, many seniors feel like they're still falling behind. Their checks are larger, but their buying power isn't. This disconnect is one of the biggest sources of frustration retirees are expressing today, and it sets the stage for why other changes, especially Medicare costs, matter so much in 2026. Medicare premiums in 2026. Why your Social Security raise shrinks so fast. After hearing about a Social Security increase, many retirees naturally expect to feel some financial relief. But for a large number of seniors in 2026, that relief is quickly reduced once Medicare costs are taken into account. This is where the numbers begin to feel disappointing, even confusing. In 2026, the standard Medicare Part B premium is rising significantly. Monthly premiums are increasing from $185 to $202.90, which means nearly $18 more per month is being deducted directly from many Social Security checks. On top of that, the annual Part B deductible is also going up, adding another layer of out-of-pocket cost before coverage even begins. When you compare these increases side by side, the picture becomes clearer. If your Social Security benefit goes up by around $56 per month, but your Medicare premium increases by roughly $18, your actual gain is closer to $38. And that's before factoring in rent, food, insurance, transportation, or prescription drug costs. For higher income retirees, the impact can be even stronger due to income-related monthly adjustment amounts, often called IRMAA. Some seniors will pay $400, $500, or even close to $700 per month for Part B alone. And because these premiums are automatically deducted, retirees feel the increase immediately, without any action on their part. This is why so many seniors say their Social Security raise feels smaller than expected. The increase exists, but rising healthcare costs quietly absorb a large portion of it. The hold harmless rule. Why most seniors won't see their checks go down with Medicare premiums rising in 2026, many retirees worry that their Social Security checks could actually shrink, even with a cost of living increase. This concern has fueled a wave of confusion online, including urgent messages telling people they must call Social Security immediately to protect their benefits. Fortunately, for most seniors, that fear is misplaced. There is an important protection built into the system called the hold harmless rule. This rule ensures that Medicare Part B premiums cannot increase in a way that causes your net Social Security check to be lower than the year before. In simple terms, if your Medicare premium increase is larger than your COLA, the system automatically limits how much is deducted from your check. And here's the key point many people miss. You do not need to do anything to activate this protection. You don't need to call Social Security. You don't need to fill out forms. It happens automatically for those who qualify. This is why so many of the panic-driven warnings circulating online are misleading and unnecessary. In fact, unnecessary calls can slow down the Social Security system and make it harder for people with real emergencies, like recent widows, disability applicants, or those facing benefit interruptions, to get timely help. Staying informed rather than reacting to urgent headlines is often the smartest move. The hold harmless rule doesn't eliminate higher healthcare costs altogether, but it does prevent the worst-case scenario, receiving a smaller check than last year. For most seniors, that stability matters more than anything. New tax deductions for seniors: who benefits and who doesn't in 2026. While many of the changes coming to Social Security in 2026 feel frustrating, there is one adjustment that could provide meaningful relief for some seniors. This change doesn't affect monthly benefit checks directly, but it can reduce how much you owe in federal taxes. And for certain retirees, that matters a great deal. Starting in 2026, Americans age 65 and older qualify for a new federal tax deduction. For individuals, that deduction can be worth up to $6,000, and for married couples filing jointly, up to $12,000. This is in addition to the standard deduction and is designed specifically to help older Americans manage rising living costs. However, this benefit is not universal. The deduction begins to phase out once income exceeds $75,000 for single filers or $150,000 for couples. For middle-income retirees, this can mean real savings. Some estimates suggest tax reductions of around $1,000 per year. That's money that can help offset healthcare costs, insurance premiums, or everyday expenses. It's important to be clear about what this change does not do. Social Security benefits are not suddenly tax-free, but for retirees who are already paying federal income tax, this deduction can lower the total tax bill and slightly improve cash flow. For lower-income seniors, the impact may be limited simply because they weren't paying much federal tax to begin with. And there's another key detail to remember. This deduction is temporary. Unless Congress extends it, the provision is scheduled to expire in 2028. Understanding this change now gives retirees time to plan, adjust withholding if needed, and avoid surprises when tax season arrives. Working while on Social Security. The 2026 earnings limit explained clearly. For many Americans, retirement is no longer a clean break from work. A growing number of seniors continue working part-time, consulting, or taking seasonal jobs while collecting Social Security. Because of that, the earnings limit is one of the most important rules to understand in 2026. If you claim Social Security before reaching full retirement age, there is a limit on how much you can earn without triggering a temporary reduction in benefits. In 2026, that annual earnings limit increases to $24,180, which is about $1,000 higher than last year. If you earn more than that amount, Social Security withholds $1 in benefits for every $2 earned over the limit. This rule often causes unnecessary fear. Many retirees believe that earning too much means permanently losing benefits. That is not how the system works. The reduction is temporary, not permanent. The withheld benefits are tracked and later returned in the form of a higher monthly payment once you reach full retirement age. There is also a different, more generous rule for the year you reach full retirement age. During that year, the earnings limit jumps to over $65,000, and the penalty is smaller, $1 withheld for every $3 earned over the limit. And once you reach full retirement age, the earnings limit disappears entirely. You can earn as much as you want with no reduction at all in your Social Security benefits. Understanding this distinction can prevent costly mistakes. Some seniors turn down work opportunities unnecessarily, not realizing that the long-term impact on their benefits is neutral or even positive. Knowledge here creates flexibility, not risk. Disability benefits in 2026. Understanding SGA limits. Without fear for Americans receiving Social Security disability benefits, even small rule changes can create anxiety. In 2026, one of the most important numbers to understand is the substantial gainful activity limit, commonly known as SGA. This limit plays a critical role in determining whether someone is considered disabled under Social Security rules. In 2026, the SGA limit for non-blind individuals increases to $1,690 per month. If a person consistently earns more than this amount, Social Security may determine that they are able to engage in substantial work activity, which can place their disability benefits at risk. For people living close to that threshold, the difference of a few dollars can feel enormous. What often gets overlooked is that Social Security does provide work incentives designed to encourage people to test their ability to work without immediately losing benefits. Programs like the trial work period allow disability recipients to earn income for a limited time while still receiving full benefits. However, these rules are complex and not always explained clearly, which leads to confusion and fear. This is where many people get into trouble. Without understanding the limits, someone may unknowingly exceed SGA and trigger a review, or they may avoid working altogether out of fear of losing everything. Neither outcome is ideal. The system is meant to balance financial security with flexibility, but only if the rules are understood. For disability recipients in 2026, knowledge truly equals stability. Knowing where the limits are and how work incentives function can make the difference between gradual progress and sudden financial disruption. SSI changes in 2026. Small increases, outdated rules, big consequences. For Americans receiving Supplemental Security Income, or SSI, the changes in 2026 may feel especially frustrating. While there is a small increase in benefits, the underlying rules remain largely unchanged, and those outdated rules continue to create real hardships for some of the most vulnerable people in the system. In 2026, the maximum federal SSI payment for an individual rises to $994 per month. Any increase is welcome, but this amount remains far below what most people need to cover basic living expenses. Housing, utilities, food, and medical costs have all risen far beyond what SSI was originally designed to support. Even more concerning are the resource limits, which remain frozen at $2,000 for individuals and $3,000 for couples, levels that have not been updated since the late 1980s. This means SSI recipients are still penalized for having even modest savings, making it nearly impossible to build financial security or prepare for emergencies. There is also a serious ripple effect many people don't realize until it's too late. SSI is often linked to Medicaid eligibility, and even a small increase in income, sometimes as little as a few dollars, can cause someone to lose Medicaid coverage. When that happens, individuals may suddenly become responsible for Medicare premiums and medical costs they cannot afford. These rules were created decades ago, but their impact is felt every day. For SSI recipients in 2026, the increase is real, but so are the risks. Understanding how income and resources interact with benefits is essential to avoiding unintended consequences. Survivor benefits. Explained. What widows and widowers are often never told. Survivor benefits are one of the most misunderstood parts of the Social Security system, and unfortunately, that misunderstanding can cost widows and widowers thousands of dollars over time. In 2026, the rules themselves haven't changed much, but the lack of clear information continues to create real financial harm. Many people believe that after a spouse passes away, the only benefit available is the small $255 death payment. In reality, that payment is just a one-time benefit and, in many cases, only a small part of what surviving spouses may be eligible to receive. Widows and widowers can often claim survivor benefits as early as age 60 or as early as age 50 if they are disabled. However, this option is frequently never explained. Some people wait years without realizing they could have claimed earlier. And when they finally do apply, those missed months are usually not paid retroactively. This creates a painful situation. A surviving spouse may struggle financially, unaware that help was available all along. Others may claim too early without understanding how it affects future benefits, or they may assume they must choose between survivor benefits and their own retirement benefits permanently, which is not always the case. The Social Security system allows for strategies such as claiming survivor benefits first and switching to one's own retirement benefit later. But these options are rarely explained unless someone asks the right questions at the right time. For widows and widowers, timing and knowledge matter just as much as eligibility. In 2026, understanding survivor benefits isn't just helpful, it can be financially life-changing. Misinformation and panic. How false Social Security warnings spread. In recent years, misinformation surrounding Social Security has exploded, and by 2026, it has become one of the biggest sources of unnecessary fear among seniors. Viral videos, urgent headlines, and misleading social media posts often claim that benefits are about to be cut, accounts must be updated immediately, or payments will stop unless action is taken right away. The problem is that this is almost never how Social Security actually works. The agency does not make major benefit changes through social media or online videos. When there is a legitimate issue with your benefits, Social Security sends an official letter, not a last-minute digital warning demanding immediate action. These panic-driven messages do real harm. They push seniors to make unnecessary phone calls, overload Social Security offices, and create delays for people who genuinely need help, such as those applying for disability, survivors filing claims, or individuals dealing with serious life changes. Scammers also take advantage of this confusion. Fake warnings often imitate official language, urging people to share personal information or click links that appear legitimate. Seniors are then placed at risk of identity theft or financial fraud. The safest approach in 2026 is calm skepticism. Verify information through official Social Security notices or the SSA website. Be cautious of any message that demands immediate action or uses fear as its main tool. Staying informed doesn't mean reacting quickly, it means reacting wisely. For retirees, peace of mind is just as valuable as financial security. Avoiding misinformation helps protect both. The Social Security Trust Fund, pressure, reality, and what hasn't changed. By the time many Americans reach retirement, they have already heard years of warnings about the Social Security Trust Fund. Headlines often suggest that the system is running out of money or on the brink of collapse, and by 2026, that background anxiety continues to shape how people feel about their benefits. The reality is more nuanced. Yes, the Social Security Trust Fund faces long-term pressure if Congress does not act. Demographic changes, longer life expectancy, and fewer workers per retiree all contribute to future funding challenges. Policymakers continue to debate solutions such as raising payroll taxes, adjusting the income cap, or modifying benefits for higher earners. However, it is critical to understand what is not happening in 2026. There are no sudden benefit cuts, no payment interruptions, and no immediate structural changes to Social Security checks. The system continues to operate as it always has, sending payments on time every month. History matters here. Social Security has never missed a payment, not during wars, not during recessions, not during financial crises, and not during the pandemic. While reforms may be needed in the future, the program remains one of the most reliable sources of income for older Americans. Understanding this distinction helps reduce fear. The trust fund discussion is about long-term planning, not an imminent shutdown. For retirees in 2026, stability, not collapse, is still the defining feature of Social Security. What all these changes mean for your monthly budget in 2026. When you step back and look at all the Social Security changes coming in 2026 together, one thing becomes clear. The real impact is not found in any single rule, but in how these changes combine inside your monthly budget. For many seniors, the challenge isn't understanding one number, it's managing several moving parts at the same time. Your Social Security check may be higher because of the COLA increase, but Medicare premiums and deductibles take a bigger bite. Healthcare costs continue to rise, often faster than inflation. Housing, utilities, and insurance remain stubbornly expensive. When all of these expenses are added up, many retirees find that their margin for error is very small. This is why budgeting in 2026 requires a more intentional approach. Knowing exactly how much is deducted for Medicare, how much goes toward prescriptions, and how much remains for everyday living is essential. Small adjustments, such as reviewing insurance coverage, monitoring medical billing, or spreading large expenses across the year, can make a meaningful difference. For working seniors, income planning becomes just as important. Understanding earnings limits and tax implications can help avoid unexpected reductions or tax bills. For others, knowing which benefits are protected and which are not helps reduce anxiety and prevent overreaction to misinformation. The goal isn't perfection, it's clarity. A clear picture of your income and expenses allows you to make calmer, more confident decisions. In 2026, staying financially stable is less about dramatic changes and more about careful, informed management of what you already have. Planning ahead. In 2026, smart strategies seniors can actually use with so many moving parts in Social Security and Medicare. Planning ahead in 2026 doesn't require complex financial maneuvers, but it does require awareness. The seniors who feel the most secure are often not the ones with the highest income, but the ones who understand how the system works and adjust calmly. One of the smartest strategies is simply reviewing your benefit notices carefully. Social Security and Medicare send official letters that explain changes to premiums, deductions, and net payments. Reading these documents slowly and comparing them year to year helps prevent surprises and allows you to spot errors early. Tax planning is another area where small steps matter. Seniors who fall into the middle income range may benefit from the new age-based tax deduction, but only if they understand how it applies. Adjusting withholding, timing withdrawals, or coordinating spousal income can sometimes reduce tax pressure without increasing risk. Healthcare planning also plays a major role. Reviewing Medicare plans annually, understanding what services are covered, and anticipating prescription costs can prevent sudden expenses later in the year. Even modest savings, like avoiding duplicate coverage or unnecessary add-ons, can protect monthly cash flow. Most importantly, planning ahead means resisting fear-based decisions. Avoid reacting to headlines or viral warnings. Instead, rely on official information, ask questions when needed, and take time before making changes. In 2026, steady, informed choices are far more valuable than rushed ones. Common Social Security mistakes seniors make and how to avoid them. One of the hardest lessons many retirees learn is that small misunderstandings about Social Security can lead to long-term consequences. In 2026, most financial problems tied to benefits do not come from bad luck. They come from avoidable mistakes made without complete information. A common mistake is claiming benefits without understanding the timing trade-offs. Some people claim too early out of fear that the system will change, locking in permanently lower payments. Others delay too long without a clear plan, missing months or even years of benefits they could have safely received. Another frequent error involves working while collecting benefits. Many seniors either earn too much without realizing how withholding works, or they turn down income they could have earned because they fear permanent benefit loss. Understanding that most reductions are temporary can prevent both outcomes. Healthcare decisions create another layer of risk. Failing to review Medicare options, misunderstanding Part B premiums, or ignoring ERMAA thresholds can quietly reduce monthly income. These costs are often deducted automatically, which makes them easy to overlook until the damage is done. Finally, misinformation plays a powerful role. Seniors who react to urgent online claims often make rushed decisions, changing accounts, calling unnecessarily, or sharing personal information. The safest approach is always patience and verification. Avoiding these mistakes doesn't require expert knowledge, just awareness, calm decision-making, and a willingness to ask questions before acting. Final thoughts: stability, awareness, and confidence moving forward in 2026. As we look ahead to 2026, it's clear that Social Security is not facing a sudden collapse, but it is evolving in ways that require attention. Benefits are increasing, but so are costs. Rules are adjusting, but protections remain in place. The challenge for seniors is not fear, it's understanding. For most retirees, Social Security will continue to be the financial foundation it has always been. Payments are still reliable. Protections like the hold harmless rule still apply. Survivor benefits, disability rules, and earnings limits still follow structured systems. What changes is how these pieces interact with rising healthcare expenses, taxes, and everyday living costs. Confidence comes from clarity. Seniors who take the time to understand their benefits, read official notices, and question sensational claims are far better positioned to protect their income and peace of mind. Calm awareness, not urgency, leads to better decisions. The most important takeaway is this: you are not alone in feeling confused or concerned. Millions of Americans are navigating the same system, facing the same questions. Staying informed, sharing experiences, and approaching changes thoughtfully can turn uncertainty into control. Social Security in 2026 is not about panic. It's about stability, awareness, and moving forward with confidence, one informed step at a time.